So I'm going to do a market update and a forecast. So I'm going to try to give you where the data is currently, and I'm going to try to give you a forecast. And I'm going to be doing this on a more regular basis going forward, both because it's good to do, but also because things are going to change. There are probably going to be some changes, and some of them are going to happen fast, some of them are going to slow, but without a doubt, the real estate market is probably going to look different 6 months from now. And the real question that I think is on everyone's mind is how different is it going to be? So, with that in mind, I like to remind everyone that the mass media headlines, I mean, a lot of folks that I talk to, they watch the news and, CNBC and all the rest, and I watch them too. But generally, when I start seeing headlines, it's 4 to 6 months after I see stuff that's already happening in the market. So, I mean, a good example is came out last week, and the Fed said that buyers and prices were starting to get not related to each other. The buyers were no longer looking at fundamentals, and that's what basically happened 6 months ago. I mean, probably somewhere around October, prices kept going up and interest rates were no longer going down, so that no longer made any sense. When prices go up and interest rates go down, that makes sense. But when prices continue to go up and interest rates are not going down, it makes a lot less sense unless it's by a small amount, and it wasn't. So it was very messy. So, and also, generally that stuff is from coast to coast. I mean, it doesn't really help you with what's going on in New England or Massachusetts specifically, or even inside 128 and outside 495. Those are all different markets, and each one of those markets has a condo market and a luxury market and a mid market and a first time buyer market. Those are all different. They don't always move in tandem. They don't always move together. So if you really want to understand what your market is doing, that's definitely something that you should ask about, because just because $1 million house is not selling doesn't mean that the market under 350 isn't really tight, or that it's a bad market for flippers. I mean, you can't tell by looking from one to the other. So the market's always changing. It's always different. And so, you got to pay attention to that stuff. The big news, though, is that interest rates are up. I mean, they've rocketed up from 3 to 4.5, and they're threatening to break through 5 for the average person. But that doesn't mean that things are going to slow down right away. So usually when we see a sharp rush up in interest rates like we have, things get worse before they get better. People are worried when interest rates go to 5 that they're going to go to 8. So instead of saying, hey, stuff doesn't really make sense at these prices, instead it's sort of like, they got to get something. Okay, they've got to finish before things get worse. So interest rates probably aren't going to get that much higher, but it doesn't matter, because the buyer behavior will be to grab what is out there and see if they can get it under agreement before things get worse. So, but the bottom line is as long as interest rates stay elevated, and they probably will, it'll take 2 to 6 months for it to really affect buyer behavior, right? And we'll talk a little bit about what needs to happen before we start seeing that stuff. The key numbers that I watch, I'll try to go over them in each update report. I watch rentals. When you see an increase in rentals, it means that buyers have started to find houses to buy and they no longer need to rent. And it also indicates that there are too many investors in the market and they've gotten overly bullish about rent projections. So it's not the best indicator, but it's definitely one that I look for. It's one of the ones that really tipped off the last top in 2005. Another one is multifamily supply and days on market. Sellers of multifamilies are trying to maximize what they can get, and the buyers of multifamilies are heavily influenced by interest rates, largely because a lot of them are not going to live in these properties. They're buying these properties because they want them to generate cash. A rise in interest rates coupled with a rise in prices means that a lot of them will not generate cash, and they'll just stop buying them. So we'll see multifamilies come on and not sell. And that means that the supply and days on market will increase. Same thing with luxury homes. If you're borrowing $200,000 to buy a condo and rates go up, I mean, it hurts, it doesn't help, but it's not a ton of money. It might be $50 a month or something, right? But if you're borrowing $700,000 or $800,000 to buy a house, and I know that that sounds crazy, but people do this, They do borrow that kind of money to buy a luxury home. Sometimes they borrow even more. So, but all of a sudden, if interest rates go up from 3 to 5, that makes a difference in how much leverage someone really wants to get to the market. So we start to see luxury home supply and days on market increase. And then I look for, really just the overall market, the main market. I don't just watch the main market because it tends to react slower. The multifamily and the luxury markets are going to be early indicators of where we're heading. And so this is a good report because right now we're not really seeing very much. So rentals remain exceptionally hard to find. They have been for years, but rents continue to go up and you still can't find them. So until that reverses, it's still going to be cheaper to buy a house, and that's still going to keep a lot of people hunting and looking for houses and trying to get off the rental roller coaster. Multifamily supply is growing, but off of such a low level, I'm not sure that it means anything. And the days on market is up, but not by enough where it really tells me that the investors are getting out. Again, this doesn't really surprise me. Rates have only been up for 3 weeks, maybe a month at most. And that's really not enough time for it to start working its way into buyer behavior. It's not going to do it yet. So we need to see more supply. We need to see buyers opting not to pay certain prices, and then we'll learn what's going on. Luxury supply is not growing. I've been watching this pretty closely. It's just not growing anywhere near fast enough to indicate that some sort of collapse is imminent. And the main market, supply and days on market, it's extraordinarily difficult for buyers. Inventory remains about 75% of where it should be for a typical April. That means that where normally there would be 4 houses for sale, there's just 1 house. Very, very difficult. So again, and that's not going to fix itself in a month. It's not going to fix itself in 2 months. So I think the big misunderstanding that a lot of people have that I've been talking with is they're saying, well, prices are very elevated, which they are, and they are hopeful that there will be a big pullback. I think that there will be a pullback, but only because the last 6 months has seen buyer behavior that's not tied to fundamentals. Okay, and so that's going to have to pull back. There's not a lot of sales because there haven't been a lot of houses, but the few houses that have not been bought at, on average, on very good prices. It doesn't mean everything's overpriced. Not everything is. There's still stuff out there that makes sense, that not everything's getting overbid. It is possible to find stuff that makes sense, but the number of mistakes that I would say buyers are making is much higher than it normally is. Normally it's maybe 1 out of 50 houses or 1 out of 100 houses where you really see, a buyer sort of chase a house, right? And now it's like 1 out of 5 where they're just doing things that don't seem to make sense based on the past sales. They're just pushing the market up. And that encourages sellers to go out there at prices that, are very high. And ultimately, it will decrease the number of buyers that are available to buy those houses, and things will start to even out. And if it goes on long enough, then they'll start to go down. But inventory is so low that I think people should be aware that, prices are not likely to head down in any meaningful way for some time. We need way more supply for that to happen. So the prices today are the prices. And so eventually, though, the rise of interest rates will dampen enthusiasm, which is important because that pulls buyers out of the market. They just stop looking. And we've definitely seen that already. We've seen that over the last 12 months. So there's definitely fewer buyers today than there were. But it also reduces their buying powers. They can't pay as much as they could before. So if you had, 10 people bidding on an $800,000 house, now there's probably only going to be 4 people because 4 of them are going to be so over leveraged that they can only afford $750. So when it comes out there at $800, they're not going to be able to get in the mix. I think what we're going to start to see is the ratio of underlisted sellers and overlisted sellers will start to change. So I think we're all familiar with the underlisted sellers right now, and if you're not, you should be. This standard listing proposal right now is to take a property and underlist it, deliberately put it below the market where the market will price it, in order to create a feeding frenzy for everyone that comes in and sell it in a weekend and get people to, drop all their clauses. I mean, listen, it's a great strategy for sellers. Okay, why don't we do it all the time? Well, we don't do it all the time because it doesn't work all the time. A lot of markets, you don't get that pop because the buyers aren't so crazy and not worried about risk. I mean, usually they're worried about risk. Usually they worry about stuff. They don't want to do work. They don't want to buy houses that have tough locations. We're not really seeing that in this market, which is one of the reasons why the prices they're paying are untethered. They're pretending that there is no risk, but there is. There's always risk in housing. And right now we're not really seeing a lot of sellers overlist. Normally we see a fair amount of the market list too high, specifically in April and May, and we see them overlist because their intention is to cut prices through the spring until they find out where the market is. That's usually a good strategy. In this market, there's much fewer people doing it because it's much easier to get the result you want by underlisting. But normally underlisting is not a popular strategy, and overlisting is a more popular strategy, and we'll probably see that return to historical norms probably soon. I mean, I would say probably by June that ratio is going to start to look more normal. I think a pullback in the ultra luxury market has probably already started. It's hard to say right now, but I suspect it will probably start soon. What's really interesting, the answer we really don't know is, if a seller has to spend 60 days on the market to sell their house, what do they do? Do they quit? Do they leave the market entirely, or do they cut prices? Ultimately, if we want to get rationality back in the market, they have to stay on the market and cut prices until they find a buyer. That creates supply of houses to buy and helps create rational pricing, because other brokers can look and see that house, see where it didn't sell, and then make sure that the next house doesn't try to reach that high. So that's how you get rationality in the market, is by stuff not selling. When everything is selling, everyone's going to reach for the next rung in the ladder. Okay, and that's really what we've got now. So what we really don't know is when things turn around, what the seller behavior will be. So they'll need to stick around if we're really going to see any kind of market softening. And right now, it's not a question that the sellers need to answer, so they haven't answered it. I think folks that are in the mid-market and the first-time buyer market, you should be aware that that's going to stay incredibly competitive until mid-May at the earliest. There's just no chance that we get enough inventory for that market to sort of function normally, because we're just too far behind the curve. We would need weeks and weeks of inventory to sort of completely wipe out the top part of the market. The number of buyers that are really aggressively writing offers. I mean, once they're gone, all the rational people are left underneath. But right now, the houses just aren't coming on fast enough to sate the demand of the people who really want to buy stuff. So again, luxury market, we'll probably see something sooner rather than later. But right now, we're not seeing anything. So just a little note here, that's really the big forecast for everyone. But I did put some stuff on here about the problems with standard market metrics that I know a lot of people are listening to. You'll hear a lot of the stuff where they say, well, in April this year and April last year, the number of listings is up month over month. It's like a terrible metric, okay? I mean, when people decide to list, people make a decision to list not based on whether or not it's April. They make a decision to list whether or not it's 2022 or 2021. So you really need to look at multiple months to sort of get an idea of the trends. And people will talk about that stuff, but it doesn't mean anything. It doesn't help you figure out what's going on the ground. Same thing with median or average price numbers. When the luxury market is really moving, then the average price paid tends to outpace. I mean, it looks really high. So I suspect when the luxury market stops selling, you're going to start to see the average price numbers go down, but a lot of that's going to be driven by a few houses at the top. It's not really, you're not going to see any price decreases in the mid-market, even though the national numbers are going to show that prices are down. I mean, if you were getting 2 million and now you're getting 1.8 million, that affects the average price. That's a big number to move, but that's not going to affect the average person. It's not going to, it doesn't mean anything to the average person. So be aware that those numbers are probably not going to be very useful. And they always report the mortgage application numbers, and those are useful if they pull the refi data out. I mean, there's not going to be a ton of refis going forward. Most people have already done that. And with interest rates up, it doesn't make sense for people to refi. But way too often, those numbers are mixed together and they don't spend a lot of time sorting it out. But more importantly, the number of people who are applying to get a mortgage doesn't necessarily mean that they're going to buy a house. It means that they're intending to see how much they can qualify for and that they might buy a house. And in some markets, all the people who are getting mortgages buy houses, or almost all. And in some markets, a lot of people apply and don't buy any houses at all. And that's really what we've seen over the last 2 years. Lots of people have gone out and getting pre-qualified, but they haven't been able to find what they want at the price they want, so they're not buying. So again, that's why those numbers don't necessarily make any sense. I think if you really want to look at stuff that does make sense, you look at days on market and you look at the dollars per square foot being paid, asked for and being paid. If the dollars per square foot being asked for starts to come down, it means the sellers know the top is in and they have to go down to meet the market, and the buyers are willing to wait it out. If the dollars per square foot is going up, well, then it tells you that the buyers are impatient and they're willing to pay more to get the house that they want. Very simple stuff. But those are more relevant numbers to figure out what your local market is doing, and you should probably be paying attention to those. So that is the report for this month. I won't be doing another one until at least May, and there's more data there, but that should give you a forecast going forward. Have a good one.